Hello, I'm Jared Nelson, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. Markets started last week on the back foot, but rebounded steadily as the week progressed. For many investors, the correction was a wake-up call. Overstretched uptrends can snap easily and out of the blue. For some investors, however, last week was a pretty good one. This includes those who happen to own shares in the big four beverage and fast food stocks, namely Coca-Cola, Pepsi, McDonald's, and Starbucks. Why? Just take a look at their price trends. New all-time highs for 3 of them last week. The sector is roaring ahead. Surprised? Not us. These companies have been doing reasonably well despite the pandemic. Their defensive qualities are a magnet for capital seeking safety in markets. Take McDonald's. First, many of the McDonald's restaurants have drive-through capability that enables social distancing. This kept their businesses open throughout the past 12 months. Second, when people are fearful of the future, they tend to turn to comforting food that they are familiar with and, in the words of the McDonald's CEO, depend on. Customers can easily order from the McDonald's app for deliveries to their homes. Lastly, McDonald's is a global franchise. It is doing well in many countries. These arguments are applicable to many U.S. food franchises, including the Yum brand, the owner of KFC. No wonder this stock is also making new price highs. The question for many is this: are we too late to chase these big branded consumer staple stocks? There are many arguments for buying these businesses. Warren Buffett and Charlie Munger, for example, famously put forward the case for buying Coca-Cola decades ago. Their thesis is still applicable these days. Coca-Cola's earnings are extremely dependable, and the business has a wide moat. Entry into the sector is very expensive. Coca-Cola's franchise is global, and it possesses a great brand name. And the company pays good dividends. The stock is one of the sought-after dividend aristocrats, meaning stocks that pay and grow dividends regularly for decades. As of last week, Coca-Cola fetched a yield of 2.9%. If you take a long view, say 10 to 20 years from now, chances of the business continuing to thrive are high. And for your information, Berkshire Hathaway still owns 9.3% of Coca-Cola after all these years. However, many investors dislike buying these consumer stocks now because they are quite expensive. According to publicly available statistics, McDonald's price-earnings ratio is 35, Coca-Cola is 30. For Starbucks, it is triple-digit. Their high valuation reminds many investors of the situation back in the mid-90s. When the bull market reversed in 2000, it took many years for these stocks to regain their peaks. Those who bought in the late 90s suffered a prolonged drawdown. Another worrying point is that these stocks have been rallying for so long. Look at PepsiCo's chart. It hasn't had a meaningful correction since 2009, 11 years ago. Many contend that Pepsi's latest uptrend acceleration is the last phase of this long bull market. And then there's the growing problem of profit margin erosion due to inflation. The rise in commodity prices, wages, and potentially interest rates will reduce profits of these food and drink companies. For instance, coffee just hit a 7-year high last week. Will this negatively impact Starbucks? Some may even argue that a rise in the US dollar will knock some profits off these global giants, because large chunks of their revenue are in foreign currencies. Certainly, all these negative points are worth keeping in mind when analyzing these stocks. However, remember that the last phase of the bull market is usually the most profitable one, simply because of the sharp and unrelenting rise in stock prices. In terms of valuation, a stock can easily stay highly valued for some time. Being overvalued now does not preclude a stock from becoming even more overvalued in the future. At this point, the path of least resistance for all these stocks appears north. We always assume that a trend will continue until it loses some consistency. Therefore, some trading longs may be opened in the sector. A word of caution though, any long now is a momentum buy and not a value one. Stop losses are thus recommended in case the trend reverses. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.